Hello Luxo lovers! Today we'll talk about From Billionaire to Trillionaire, how Robert Kiyosaki turned the 2008 crash into billions and awaits the 2024 crash to become even richer. We'll see how he finds the silver lining in tough situations and what strategies he uses to benefit from economic downturns. Basically, we're exploring how Robert Kiyosaki turned the 2008 crash into billions and plans to become even richer with the upcoming 2024 crash. By the end of this video, you'll learn valuable tips that you can use to potentially profit from the 2024 crash. Stick around to find out more. What are you waiting for? Give Luxo-Life some love and let's get started. The 2008 financial crisis, a turning point. Let's start by going back to the 2008 financial crisis. During this time, many people were losing their homes, jobs, and savings. However, Robert Kiyosaki saw an opportunity where others saw only disaster. He believed that the best investments are made during the worst times, so he focused on buying real estate when the prices were at its lowest. This strategy allowed him to purchase high-quality properties at a fraction of their value. Kiyosaki made several key real estate purchases across the Southwest, which greatly contributed to his wealth. He bought properties in prime locations that were heavily discounted because of the crisis. These properties included commercial buildings, residential complexes, and land that had significant potential for appreciation. By acquiring these assets when the market was down, he positioned himself to benefit greatly when the economy recovered. The lessons he learned from the 2008 crash have had a lasting impact on his investment strategies. He realized the importance of staying calm and looking for opportunities during economic downturns. Instead of panicking, he carefully analyzed the market to identify undervalued assets. This experience taught him to be prepared for future crises by maintaining liquidity and being ready to invest when others are selling in a panic. Skepticism towards economic institutions. Now let's be skeptical towards economic institutions. Robert Kiyosaki often refers to the Federal Reserve, the Treasury, and government leaders as the Three Stooges. He uses this nickname to highlight his distrust in their ability to manage the economy effectively. He believes that their policies often create more problems than they solve, leading to economic bubbles and financial instability. He argues that these institutions are more concerned with short-term fixes rather than long-term solutions, which makes them unreliable in his view. Kiyosaki's skepticism towards these entities profoundly impacts his investment decisions. He tends to avoid traditional investments like stocks, bonds, and mutual funds, which he believes are heavily influenced by government policies and economic manipulation. Instead, he focuses on tangible assets such as real estate and commodities like oil, which he feels offer more security and potential for growth regardless of government actions. His distrust in economic institutions also shapes his broader financial philosophy. Kiyosaki emphasizes the importance of financial education and independence. He encourages people to think critically about the information they receive from mainstream sources and to seek out alternative viewpoints. By doing so, he believes investors can make more informed decisions that are less influenced by the potentially flawed policies of the Three Stooges. The longest bull run and its implications. Fast forward to 2011, we saw the beginning of the longest bull run in history. This period of sustained growth in the stock market was fueled by various factors including low interest rates, quantitative easing by the Federal Reserve, and an overall economic recovery following the 2008 financial crisis. As a result, asset prices surged and many investors enjoyed substantial gains. However, such prolonged growth also led to concerns about overvaluation and the potential for another significant market correction. Robert Kiyosaki, always cautious of market bubbles, has been critical of this bull run. He believes that the same policies that drove the market up have also created unsustainable economic conditions. He argues that low interest rates and excessive money printing have inflated asset prices beyond their true value. This skepticism has led him to avoid traditional investments like stocks and instead focus on assets that he believes will hold their value or appreciate during economic downturns. To prepare for the anticipated 2024 crash, Kiyosaki has positioned himself strategically. He continues to invest heavily in real estate, which he considers a more stable and reliable asset. Additionally, he invests in commodities such as oil and gold, which he believes will perform well when the market corrects. Investment philosophy and strategies. Now let's discuss some philosophy and strategies that Robert Kiyosaki uses in his investments. One of the key aspects of Kiyosaki's approach is his use of debt as an investment tool. Rather than seeing debt as something to avoid, he uses it to acquire real estate and invest in oil wells. By leveraging debt, Kiyosaki can control large assets with relatively little of his own money. This strategy allows him to generate significant returns on investment while conserving his capital for other opportunities. He also benefits from various tax advantages that come with his investments. When he invests in real estate, he gains from appreciation as the property value increases over time. Additionally, he can take advantage of depreciation, which allows him to deduct a portion of the property's value each year from his taxable income. Amortization of loans also provides financial benefits, as the interest payments on his debt are often tax-deductible. These tax breaks help Kiyosaki to reduce his overall tax burden and increase his net income from investments. In contrast, Kiyosaki avoids traditional investments like stocks, bonds, mutual funds, and ETFs. He believes these types of investments are too susceptible to market volatility and economic policies that are beyond his control. Instead, he focuses on tangible assets such as real estate and natural resources, which he views as more stable and reliable. Warning and advice for investors. Of course, we want you to be very equipped, so take note of these warnings too. Robert Kiyosaki has been vocal about his belief that the current economic bubble is even larger than the one in 2008. He points out that the extensive use of low interest rates and massive money printing by central banks have created unsustainable asset prices. According to Kiyosaki, these actions have inflated real estate, stock markets, and other assets to levels that are not supported by underlying economic fundamentals. His warning is crucial for investors to consider. He argues that when this bubble bursts, the impact could be much more severe than what we experienced in 2008. He advises investors to be cautious and to prepare for potential downturns by diversifying their portfolios and focusing on tangible assets. By understanding the risks of the current economic environment, investors can make more informed decisions and avoid being caught off guard by a sudden market correction. Another important piece of advice is the need for critical thinking and careful evaluation of information sources. He stresses the importance of being cautious about who you listen to when it comes to investment advice. Many mainstream financial advisors and media outlets may have conflicts of interest or may not fully understand the complexities of the market. That's why we, together with Robert Kiyosaki, encourage investors to do their own research and seek out diverse perspectives to form their own opinions. Future predictions and preparations. In this part of the video, let's discuss Robert Kiyosaki's predictions on the 2024 crash and how he prepares for it. He believes that the economic conditions leading up to 2024 are setting the stage for a major market crash. He cites factors such as excessive debt levels, inflated asset prices, and economic policies that have created unsustainable growth. According to him, these elements are likely to culminate in a significant economic downturn, similar to or even worse than the 2008 financial crisis. To navigate this anticipated crash, he is taking several strategic steps. First, he continues to invest in real estate, focusing on properties that generate steady cash flow. He believes that tangible assets like real estate will retain value and provide some income even during economic downturns. Additionally, Kiyosaki invests in commodities such as gold and oil, which he expects to hold their value or even appreciate when traditional financial markets falter. His preparations also include maintaining liquidity. He emphasizes the importance of having cash on hand to take advantage of investment opportunities that arise during a market crash. By being liquid, he can quickly acquire undervalued assets when others are forced to sell. This strategy positions him to benefit from market corrections rather than being negatively impacted by them. Philosophical underpinnings of Kiyosaki's approach. Before we end, let's explore the philosophical underpinnings of Robert Kiyosaki's approach to investing. His strategies today are deeply rooted in the principles he outlined in his book, Rich Dad Poor Dad. In the book, he contrasts the mindset of his rich dad, who believed in building wealth through investments and entrepreneurship, with that of his poor dad, who believed in job security and saving money. These principles emphasize financial education, investing in assets that generate income, and thinking differently from the crowd. Kiyosaki's current strategies reflect these rich dad, poor dad principles. He focuses on acquiring assets like real estate and commodities that generate cash flow and provide financial stability. His use of debt to invest in these assets aligns with the book's advice to use other people's money to build wealth. Kiyosaki's skepticism towards traditional investments and government institutions also ties back to the book's encouragement to think independently and question conventional wisdom. Tracing the evolution of Kiyosaki's investment philosophy reveals a consistent application of these principles. Before the 2008 crash, he was already advocating for real estate investment and financial education. The success he found during and after the crash reinforced his belief in these strategies. Over time, he has become more vocal about the risks he sees in the economy and more focused on preparing for potential downturns. His approach has evolved to include a greater emphasis on maintaining liquidity and investing in commodities like gold and oil. By connecting Kiyosaki's current strategies to the principles in Rich Dad Poor Dad, we can see a clear, thorough line in his investment philosophy. His focus on financial education, income-generating assets, and independent thinking has remained constant, even as his specific strategies have adapted to changing economic conditions. This evolution demonstrates the enduring value of his principles and offers a roadmap for anyone looking to build and protect their wealth in uncertain times. And that's it for today's video. We hope you've picked up some strategies that will not only serve you well in 2024, but also enrich your life in the years to come. If you found today's video helpful, hit that like button and drop a comment below with your thoughts. Don't forget to share this video with others who might benefit from it. If you're new here, subscribe and ring that bell so you don't miss any updates. See you next time, Luxo lovers!